Well, we're going to do something a little different today. We're going to do a regular podcast. Chris Pedersen is joining me, and what we're going to do is we're going to talk about the coming months, the coming year, and some of the projects we're working on, problems we hope to solve for our viewers and listeners, and talk about some of the ways that we're going to improve a couple of the major strategies we're working on. So with that, Chris, welcome again.
Thanks.
It's great to have you.
Great to be here.
So let's talk up first. I've got a nice list here of things that I'm certainly interested in. And first of all, you've done some great work in this best in class.
Thank you for that.
And not everybody may know what that is. So why don't you first of all just tell us a little bit about that strategy, and then we'll dig in and a little deeper.
That was something I cared a lot about when I first started working with you, because I had followed your work and I knew that you had this portfolio recommendation and you had a way to implement it at Vanguard or a way to implement it at Charles Schwab or at Fidelity, and you had chosen those funds to be commission-free. But the question I had is, what if I'm only trading once a year and the commission's not a big part of it? Which is the best fund, right?
Mm-hmm.
I'd really rather have the best of the funds, whether they're from Schwab or from Vanguard or from Fidelity. And so when I first started working with you, we worked on really analyzing all of the different options, the mutual fund options and the ETF options, to build the ultimate buy and hold portfolio with the ultimate funds. Yeah. And that was fun. And it took a fair amount of work, and it was a great education. I learned a lot. It involves looking at all the things you've talked about in the past. How value-oriented is that fund? If you're looking for a value fund, some are more discounted, some are less discounted. How large or small are the assets? How many equities are held in the fund? How much turnover is there? How much tax is there as a result of the turnover? So there's all these different factors, and we did it the first time 2 years ago. We updated it last year, and I think we'll try to keep updating it every year.
And first quarter next year, would you expect to do the update? Is that the goal?
Ideally, I'd like to have it before the end of this year, but first quarter of next year seems a fair promise. Yeah, it's kind of a busy time of year. If I shift to where it's in the first quarter of the year, that'll actually be a lot easier for me because it's not on the Christmas season. But
Got it. And I think you've probably seen a number of questions that keep coming up about selection of exchange-traded funds.
Yep.
What's the most common question that you get, and what's the answer?
The most common question I get is, why didn't you choose this fund, right? So there's other fund choices, and there's art in the selection process. It's not black and white. You can start with that same set of criteria that I just described and you've described many times and come to different conclusions. Because you might decide that you care more about the value orientation than you do the size orientation. Or maybe somebody else cares more about the size orientation than they do the value orientation. Or maybe they're put off by some other aspect of the fund. For example, RZV, which we had in there for a long time, people took us to task on the fact that it has negative momentum. That's not a first order thing I filter on usually, but it is something that affects the fund performance. So that's the biggest question, is why didn't you pick Fund X instead of Fund Y? And there are two answers to it. One answer is we do update the analysis once a year. So it's possible that Fund X is actually better and I haven't had time to analyze it and it's worthwhile considering. The other possibility is that we just weighted the factors differently that went into the choice. We also look at, when I do the best-in-class selection, I analyze the whole thing together. When I get done, I run it through a Morningstar X-ray to look at what the whole thing looks like. And then I compare it to DFA as a benchmark.
Good.
And so in doing that, sometimes you get to the end of it all and you add it all up and you say, you know, it looks pretty good, but our expense ratio is a little higher than I want. And then you go back and that can impact changes in the fund choices too.
So what would that decision be about expenses versus value orientation? Where would you, can you think of an example where you might lean to the value even though you're paying an extra 20 basis points or 30 basis points?
You might, and it would be a very rational decision because the FAMA French data says that in getting down to those lower deciles, you're picking up single-digit percentage points of added return historically. Mm-hmm. So paying another 20 basis points to get a deeper discount could very well make sense. There's no mathematical relationship that says it's worth this or it's not worth that, that you can actually just rely on for making the trade-off, because there's all the other factors that make it an art. But yeah, sometimes we'd pay more to get more discount or to get smaller. Yeah.
We have a fellow who follows our work who emails me every time he finds an article that says that growth is really better than value. And
it might be
well,
today.
Today, that's right. And I had just seen a DFA workshop online where Dr. French was discussing this value versus growth, and he made the point that about, I think, 15% of the 10-year periods, historically going back to 1928 probably, that growth has in fact outperformed. Now when we get out to 40 years, we don't see that.
Right.
But what would be your way of scientifically responding or emotionally responding to even a longer period of time? How long would you think you would wait to come to the conclusion that instead of overweighting the portfolio to value as we do now, you would overweight to growth? Could you, and would you have to see it working in international as well as U.S.? Would you have to see it working in large as well as small? How much evidence do you need?
Yeah, that's deciding what we believe is really important.
Yeah.
Right. Trying to figure out. I think somebody who is asking that question based on a shorter period of time is, in some ways, they're saying, I'm really a trend follower, right? In some ways, they're saying maybe they're not a day-to-day trend follower. Maybe they're the decade trend follower. Maybe they're the 5-year trend follower. So, for me personally, I derive the most confidence out of the most history. So the data that you just mentioned, for example, if there's an asset class that's going to outperform 15% of the 10-year periods, but the other one's going to outperform 85% of the 10-year periods, I'd rather be invested in the one that's 85% of the 10-year periods. And it's interesting, when we go through doing the best-in-class work, I do my level best to ignore recent performance. The last 5 years, I never look at. If I have 10 years, it may be interesting because it might flag you that they have a high expense ratio or they have high turnover that's creating a tax burden. Sometimes if they're underperforming their benchmark, it can tell you something over a long term. But the recent history is practically useless. Yes.
It's also a challenge, I think, that particularly with mutual funds, maybe more than ETFs, that they have not been consistent in their asset class exposure. Mm-hmm. So you could see a fund that just pure good luck may have made a market timing move that worked, and it makes the whole fund look different than it really is. That's the beauty of index funds. You don't have to deal with that as often. But you mentioned DFA. You went to a DFA conference.
Yes, thanks to you.
Well,
I think you got sick and gave me your slot.
My wife got sick.
Oh, that's
happened.
what it was.
Yeah,
that's what it was.
She did. And I would love to have been there. I was happy you were there. I can't think of any days in my life that have been much more fun than going to a DFA conference. Because there are a lot of people out there who who might be thinking about going into the business.
Uh-huh.
And I always try to get people who are thinking about going into the business to figure out a way that they end up working with DFA if they're going to be managing money for large accounts. But what did you come back with? And how will it impact the work that you're doing here at the foundation?
I came back really impressed with how genuine and sincere their efforts are to create a set of consultative advisors. They put a tremendous amount of effort into being fact-based. They really do emphasize the academic research and the data that drives their investment philosophy. The people who I met there that were attending were mostly financial advisors, and they seemed genuinely interested in learning and being better prepared to advise their clients. So that was the most impressive thing to me at a personal level. And then the way they taught it, they would often ask questions that were designed almost to catch you being a human, as opposed to being the rational investor they're trying to train you to be, right? So they would ask a question like, what do you expect bond returns to be in the next 5 years, right? And I reflexively said lower, because we've come off a history of a long period of good bond returns, and so I expected them to be lower. Of course, the interest rates are going up. There could be a period of time when they're up, when they're down. The truth is we don't know, and that's the answer they wanted, is I don't know, right? Yeah. And so it's a great process of reminding you that you're not as rational as you think you are, and helping ground you in things that help make you more rational. They gave us a tour of the trading floor. They took us upstairs, and we got to see, kind of where the nuts and bolts of the work gets done, and it was very calm, right? Because that's the way they run their funds. They're very calm. They're very patient. They know what they're about. They're not going to do things impulsively. They're going to try and do them in a way that doesn't create too much of a tax burden, doesn't create unnecessary trades, doesn't mess up the tilts towards small and value that they get in all of their funds, and also preserves this massive diversification they get by holding a very large number of assets. So yeah, it was very impressive and fun. So thank you. Well, it was a great pleasure. It was really neat to be there.
Good. So then it leads me to this question about DFA, dimensional funds, versus the best in class with ETFs. How close are we getting to producing with these ETFs what DFA is able to produce? Now, understanding that there are going to be times DFA is not certainly number one, that when large is doing better than small, then DFA is probably not going to be number one, and when growth is better than value, DFA is not going to be number one. But given that, how close do you think we can come?
There's sort of two questions in there. I think an investor who would ask exactly the same question might be saying, how close will my return be to DFA? And you kind of answered that question in the way you asked it, which is that it depends on what the market's doing. There will be periods of time when DFA's strategy works great and delivers performance ahead of other commonly available funds and benchmarks. And there'll be periods of time when small and value are out of favor and they don't do well. So that's going to be a luck question, right? There'll be periods of time when it goes well and doesn't, and the ETFs will outperform or they will underperform. When you get, though, to the metrics that really make the DFA engine tick, it's hard to match. We can do things to achieve a similar level of value orientation and size, but then we give up diversification. Right. There's not as many funds, or not as many holdings within the funds, not as many stocks. So right now, today, with the funds that are offered, we do our very best to come close, and I think investor returns will be good following a strategy with ETFs or mutual funds. But unfortunately, the investor really is faced with a combination choice when they think about DFA. If you want all of the goodness that they have, their patient trading, the lower tax consequences of that patient trading, the advantages they have in efficiently trading small and value stocks, and the broad diversification and the deep discounts and all of those things, you have to work with an advisor for a fee.
Yeah.
So it's a combination choice because you're not just choosing to get all the goodness of their funds, you're also choosing to have somebody there to help you and provide value add. The question is that value add worth it to you?
Yeah.
So it's a combination choice, and I think it will be for some time to come, but we'll keep trying to do the best we can with the alternative funds for the DIY investor, the do-it-yourselfer who wants to manage his own money and not pay the fees.
And on top of that, there's the huge decision of which advisor. That's much more difficult than which supplier of mutual funds, because we were talking yesterday about how tax knowledgeable advisors can or might not be.
Mm-hmm.
And if you're paying for an advisor, you better be getting that expertise.
Yes, absolutely.
So we just got done a little while ago recording the piece on the two funds for life strategy. And my hope in reaching a lot of people is that somehow we can tell this story and help people make the combination choices for two funds in major 401, well, in all 401k plans. How can we do that? I see some 401k plans from huge companies that the offerings are not very good, and not everybody has Vanguard. Some people have target date funds that are expensive, and there's all sorts of costs that we don't want them to pay. But what do you think the most efficient thing we can do for the most number of people in trying to help people determine how to put together those two funds for life strategies?
Well, I think the combination of the best-in-class ETFs and mutual funds with as much education as we can give them about the consequences of the different options they have available to them set them up pretty well. Because somebody can look at the stuff that we're publishing on the Two Fund for Life, the article that's going up on the website. They can look at that and see what they would experience in terms of the bumpiness of the ride, the amount of drawdowns at different ages, and also what kind of growth they might expect out the other end for the investments that they make. And then if they want to implement it, the question is, well, which funds to choose to do it. In the case of something like augmenting with small cap value, I would imagine most people would pick the small cap value fund we had. If somebody wanted to go extra credit and get fancy, they could say, I still want an international diversification in there. I'm going to take the international small cap value and the U.S. small cap value best in class.
Yep.
And
3 funds for life.
Right. So make it a little bit more complicated if that's what they want to do, right?
Yeah.
I think the best thing that we do is provide information that helps make an informed choice, helps people understand there are ways they can get a better return by taking a little more risk, and what does that risk look like? Hopefully it's prudent risk. And then in the case of the Merriman Aggressive Target Date Glide Path, we created a calculator, right, where people can go and customize it for their actual retirement date, their U.S. versus international split that they're comfortable with, and then they can take that and apply it.
And they could set that up with an IRA.
Right.
And that would be a good start if they wanted to do that.
Right.
But dealing with these 401k plans, we've been offering to evaluate 401k plans for years. Everyone is different.
Yep.
and we only have so much time. Is there a way that we could provide something to all investors that would give them some sort of a decision path to help them sort through those offerings on their own instead of calling me and saying, what do I do?
I think that I'm going to turn that back into a question for you because you have a lot more experience creating those 401k recommendations, right? So how do you do it? Is it something you could describe as a decision tree? Is it something we could write down and make it as a, like a cookbook thing that somebody can follow? If you have this fund, use it. If you don't have that fund, maybe use these instead.
Yeah, we're assuming, let's say, that they would all like to use small cap value if they had it.
But they may not.
And we're assuming not everybody has target date funds.
Yep.
So they may have to actually get smart and do some extra work and use an IRA to get to one of the asset classes that they need. That makes it more complex. It may even be that some people are going to have to go to the self-directed part of their 401k. At IBM, for example, if you go to their self-directed asset classes or mutual funds they have available, they have access to all the DFA funds they need. Not in their main menu, but in the what they have access to. I don't remember if it's through Fidelity or Schwab. I don't, but they can get at that stuff if they want to. So there are a lot of potential moving parts, but I'll bet we could build that decision tree because we're looking for two funds.
Yep.
That's basically what we need to find.
We could, we might even be able to do that as a little calculator on your website where somebody goes in and it just has a series of questions. Do you have access to a small cap value fund? Yes or no. Do you have access to a large cap value fund? Yes or no. And then at the end, it kind of pops out a recommendation.
Hang on one second. Do I see a show of hands of people who would like that? Yes. There we go, Chris. That's great. Overwhelming response. Let me look at my, thank you. That's great.
I think that would be fun.
Vanguard Multifactor ETFs. I get a lot of questions about what do we think? What do you think?
I love the idea of a Vanguard Multifactor ETF because it would come closer in many respects to what you can get from some of the DFA funds. There's a lot of work that says when you combine multiple factors together, you get more consistent. You get the benefits of the higher gain in the long run, and you get more consistent performance. It's more stable. It's Larry Swedroe calls it factor diversification, right? Mm-hmm. So I love the idea, and I've looked at the Vanguard funds. I've read their prospectuses and some of the Morningstar analysis on them. They seem well constructed. The problem with Vanguard's multi-factor funds is that they started out really small and haven't gotten bigger. So the liquidity's not there. You're likely to pay a large spread on them when you buy and sell them. And I think what's happening is that people think of Vanguard as low cost. They don't think of Vanguard as a factor investing firm. Right. And so when they go and they look at the multi-factor funds, they look expensive because they are expensive compared to a single factor fund. And unless they grow, that makes it hard to recommend them or even buy into them because they're kind of struggling with this issue that you pay a tax every time you buy in and sell, and it's harder to buy and sell. But if they were to succeed, it would be really nice to be able to use them as part of our portfolio because when you have a multi-factor fund, say a small value stock succeeds and grows and gets to be a large value stock, there's no trade required because it still fits the fund, and so it has a lower turnover, lower tax consequence as a result of that. It'd be a great thing to have. I hope we have it someday. So far, they just haven't grown, and that's unfortunate.
I'm going to go back for a second to the best in class versus commission free. we now have, through Vanguard, the investors do, some 1,800 ETFs that at Vanguard are commission-free. As I understand it, it does not include the DLS, the Wisdom Tree International Small Cap. And so, what is there, a $4.95 commission to add that? When you go in the first quarter or whenever you look at Vanguard and you look at your best in class, a lot of our best in class are in fact Vanguard funds.
That's true.
So it may be we're going to be able to pick up some of these on a commission-free basis that we couldn't get at before through Vanguard. But would you go ahead and buy that DLS for $4.95 or $7.95 or?
I would. So you and I've talked about the significance of the commission. Is it that big a deal? If you're a buy and hold investor in, say, an IRA where you may invest once a year and you're paying the commission, it may not be that big a deal, especially if it's only on one fund or two funds. I would definitely pay the premium to have the international small value asset represented in my portfolio, the $4 or $5. Yeah, $5.
So let me follow up on that, because one of the things that we're doing in the two fund for life strategy is, it isn't that we don't want to have international small cap value in the portfolio. We would like to do that, but that's three funds.
Right.
And yet if we look at the history, yes, international gets a small cap premium, U.S. small cap value gets a premium, and over time the returns may be similar. In fact, I think in the last 15 years the U.S. has been a little better, but they're going to be similar. Do we really need to have that other fund in there, the international, if we already have the U.S. and we're getting the small and we're getting the value, or are we really thinking more in terms of something's going to happen out there, and there's going to be a time when we'll be happy to have that international small cap value instead of having everything in U.S.?
When we did the two funds for life, we were trying to create something simple, right? To make it as easy as possible for the widest range of people to take advantage of it. But diversification is good.
Yeah.
So, and in fact, today in the market where it stands, value internationally is more value-y, right? International stocks are cheaper.
It normally is, by the way, historically.
Right, because there's a perception there's more risk. People aren't going to pay as much for it, right? But it's even more so, I think, in the moment right now. And so it's not that in recommending the two fund for life solution we're saying that there's nothing better, but it's a really good solution for a very wide range of people. And for people who want more diversification, yeah, it would be good to have some international small cap value in there.
You have people listening to you, watching you right now, and I know we're always looking for feedback. You know, we don't talk to many of the folks that read and follow us. Would you have, and I didn't ask you to do this, but do you have a question you would want to ask them, that if you got a good feedback on that question, that it would help you in any of the work that you're doing?
Yeah, I think the question I would ask is, what else can we do to help? And are we striking the right balance in terms of complexity versus simplicity? Yeah. So we really want to expose as much information as we can to help answer questions and help educate and inform. But I fear sometimes, especially for me, because I have this techie, nerdy background, that I overwhelm people with data. So I don't want to overwhelm people with data. I think you and Rich do a great job of translating that into consumable, understandable content. But I would love to have feedback on, where we could be more detailed, where we should be less detailed, and what else we could provide that we're not addressing in terms of particular concerns people have. And we do get some questions, and I love those. I love the questions that come in because it's a chance to better understand what's on people's minds and how we can help.
Great. Thank you all
Yes,
for
thank you.
listening and watching, and we'll be back soon. Good luck.